New York, the city that never sleeps. But beneath its glowing skyline, a quiet illusion has taken shape, one built on debt, speculation, and dreams that no longer match reality. For years, the New York real estate market was untouchable, or at least that's what everyone wanted to believe. Prices kept climbing, investors kept buying, and ordinary people were told that the value of property in this city could never fall. Manhattan became a brand, not a place to live, but a global commodity traded by the wealthy from Shanghai to Dubai. But behind the glamour and the glass towers, something was breaking. You could see it in the empty condos of Billionaires' Row. You could feel it in the silence of luxury apartments bought and left vacant, assets, not homes. And you could sense it in the growing divide between what people earned and what landlords demanded. The illusion began decades ago. New York's property market became a magnet for global wealth after the 2008 crisis, when the rest of the world lost faith in banks, but not in U.S. real estate. Money poured in. Hedge funds, private equity groups, and overseas investors began snapping up properties. Homes turned into portfolios. Neighborhoods turned into playgrounds for financial engineering. It all seemed unstoppable. As long as interest rates stayed low and the dollar stayed strong, the city's skyline would keep rising. But the illusion depended on one fragile thing, the belief that someone would always pay more tomorrow. And that belief is starting to die. The turning point came quietly. When the Federal Reserve began raising interest rates, the shock rippled through New York's property ecosystem. Suddenly, those massive loans that fueled development were no longer cheap. Projects stalled, buyers disappeared, banks grew nervous. The same buildings that once symbolized prosperity now stand half-empty, glowing blue in the night, monuments to speculation. For the first time in decades, prices aren't just stabilizing, they're falling. But few want to admit it. Developers still talk about temporary corrections. Analysts call it a cooling period. Yet on the streets, brokers whisper a different story. They're seeing it firsthand, the listings that don't move, the deals that collapse, the owners who quietly lower their prices month after month. New York's housing machine is slowing down, and it's not just about luxury towers. The shock is spreading across every layer of the city, from penthouses to walk-ups, from Wall Street bankers to waiters in Queens. Because the truth is simple, the entire system was built on cheap money. And when cheap money disappears, everything begins to crack. But this isn't just an economic story, it's psychological. For generations, New Yorkers were told that property was the one sure investment, that no matter what happened, prices would go up. Families stretched their budgets, buyers took out massive loans believing the dream was worth the risk. Now, that dream is collapsing under its own weight. Some are calling it the return to reality. Others call it the end of the illusion. As prices fall and the city's rent crisis deepens, something larger is unraveling, the idea that New York real estate was immune to gravity. Because gravity always wins. The next phase is what experts fear the most. A correction in the luxury sector often triggers panic across the middle class. When investors pull out, credit tightens. When developers halt projects, jobs vanish. And when homeowners start defaulting, banks feel the shock. New York is standing at that edge right now, between denial and collapse. But how did the illusion grow so powerful? And why did no one stop it? The answer lies in how the system was designed. After 2008, the government and the Federal Reserve wanted to rebuild confidence. They cut interest rates to near zero, flooded the economy with cheap credit, and encouraged home ownership as a path to recovery. For years it worked, or seemed to. Prices rose, construction boomed, and investors reaped historic profits. But the same policies that saved the economy also planted the seeds of the next crisis. When money becomes free, speculation becomes irresistible. And New York became the perfect playground, an island with limited land and infinite demand. Everyone believed they could outsmart the market. Developers rushed to build higher and faster. Hedge funds bought blocks of rental buildings and turned them into algorithmic investments. Even middle-class families joined the race, seeing condos as retirement plans, not homes. The illusion didn't just exist, it became culture. But now, that culture is cracking. In 2025, the warning signs are everywhere. Manhattan's office-to-residential conversions have slowed. Downtown towers are sitting dark, mortgage defaults are rising quietly in outer boroughs, and the city's own tax revenue, heavily tied to real estate, is starting to fall. The illusion is breaking from the top down, and as it does, New York faces a deeper question. What happens when an entire city realizes it was built on borrowed time? Because once the illusion fades, it doesn't just reveal a financial collapse, it exposes a moral one. The belief that endless growth was the only way forward, no matter who got left behind. Now, that belief is meeting reality. And reality in New York is brutal. Confidence is the most valuable currency in real estate, and in New York, it's running out. When markets collapse, they rarely do so with noise. They fade quietly, through cancelled projects, silent defaults, and the slow withdrawal of faith. That's what's happening now in New York. From the marble lobbies of Wall Street to the tiny broker offices in the Bronx, confidence, the invisible force that kept the housing machine alive, is evaporating. Investors once poured billions into Manhattan towers without hesitation. They called it safe yield, asset diversification, portfolio protection. But now, those same investors are asking the one question every bubble fears. Who is going to buy next? And no one has an answer. When the Federal Reserve raised interest rates, it didn't just make borrowing expensive, it broke the psychological loop that kept the illusion spinning. Suddenly, the endless line of buyers dried up. Developers found themselves trapped with unfinished towers, unable to refinance their loans. The same banks that financed their rise are now tightening their credit lines, refusing to extend more risk into a market that no longer makes sense. In Lower Manhattan, a developer who once bragged about pre-selling $800 million worth of condos now whispers about bankruptcy. In Brooklyn, half-completed luxury buildings stand like relics of a vanished optimism, their glass facades reflecting a city that no longer believes in itself. The illusion was never just about price, it was about belief. Belief that New York was too big to fail, that the demand for space in the world's financial capital was infinite, that the rich would always come. But now, the rich are leaving too. Some move their money offshore, others shift to Miami or Austin, chasing lower taxes and higher returns. For the first time in decades, wealth is fleeing New York, not arriving. Even Wall Street, the engine of the city's real estate boom, has started downsizing its footprint. Office vacancies have reached record highs. Companies are consolidating. Midtown, once the beating heart of global finance, now feels hollow. In the evenings, when the lights dim, you can see it. Entire floors dark, silent and empty. It's not just lost rent, it's lost confidence. And confidence, once gone, is almost impossible to rebuild. The same psychology that inflated the bubble is now reversing it. Buyers hesitate, banks tighten, landlords panic, and the spiral turns downward. Still, New York has seen this before, the 1970s, the 2008 crash. Each time the city clawed its way back, but this time feels different because this time it's not just economic, it's structural. In the post-pandemic world, remote work has rewritten the map. People no longer need to live in New York to be part of New York. The digital age has broken geography, and with it, the city's monopoly on opportunity. That's the part no developer wants to admit. The illusion of demand wasn't built on population or growth. It was built on prestige. And prestige doesn't pay the mortgage. Now, as prices soften, you can sense the denial setting in. Real estate reports still use gentle language, temporary correction, market rebalancing. But beneath the surface, the numbers tell a darker story. Luxury units are taking months, even years, to sell. Rental listings are flooding the market. Landlords are offering free months just to fill space, and still tenants can't afford them. The system is cracking from both sides, from the top where investors are over-leveraged, and from the bottom where ordinary people are broke. What's left in the middle is chaos. Yet no one wants to call it what it is, because calling it a collapse would make it real. Inside City Hall, officials downplay the risks. They fear the domino effect, the loss of property tax revenue, the shock to city budgets, the political fallout. They promise new incentives, new conversions, new dreams, but those dreams cost money the city no longer has. Meanwhile, Wall Street quietly prepares. Hedge funds are already buying distressed property loans at discounts, waiting for the collapse to finish so they can rebuild from the ashes. The same players who inflated the bubble are now preparing to profit from its fall. It's a cruel symmetry, and New York has seen it before. When the 2008 crisis hit, Wall Street crashed the housing market, then bought back the ruins. Now, history is rhyming. Only this time the stakes are higher, because the dollar itself, the foundation of the global market, is trembling. Inflation, debt, and political instability have eroded global faith. If that faith falters completely, the fallout won't stop at housing. It will spread to everything, and New York, as the world's financial capital, will be ground zero. But let's be honest, it was never just about numbers. It was about trust. The belief that tomorrow will be better, that the system will hold, that owning a piece of New York means security. Now, that trust has shattered. Walk through Midtown and you can see it in people's eyes. Brokers staring at their phones, landlords avoiding calls, construction workers standing idle beside half-built towers. Everyone is waiting for someone else to make the next move. But in a market built on confidence, waiting is death. So what happens next? If the city's property market keeps falling, the consequences could cascade. Developers default on loans. Banks absorb losses. City tax revenues shrink. Services get cut. Unemployment rises and confidence disappears entirely. A spiral with no bottom, unless something intervenes. But what could that be? A new bailout? A rate cut? Another illusion to replace the old one? Maybe, because New York has a way of rebuilding its dreams, even if it means forgetting the past. It's happened before. It could happen again. But this time, the warning signs are clearer than ever. The numbers don't add up. The debt is too high. The incomes are too low. The illusion is too visible. The city's power brokers are running out of stories to tell. And in the silence that follows, people are starting to see the truth. The skyline still shines, but beneath it lies something fragile, something built not on steel or stone, but on belief. And belief is breaking. The price illusion is more than a story about housing. It's the story of how confidence built a city, and how losing it might change everything. Because in New York, the greatest asset was never real estate. It was faith, and faith is what's collapsing.